Welcome to the Are You Ready to Take on Predictive Analytics web seminar hosted by Valen Technologies. Our speakers today are Dax Craig, CEO, and Matt Frazier, Head of Workers' Compensation Product Strategy and Development for Valen. We'll review the agenda and goals for today's web seminar. We appreciate your time today to talk about how insurance carriers can set themselves up to be successful using predictive analytics. We review the capabilities your organization needs to build use analytics effectively. The most important indicators for success is dedicated commitment from the senior management team, and like any group of executives, they need certain proof points, goals, and plans in place in order to commit. And finally, we'll show real examples of success carriers have had using predictive analytics and to kind of build on those early wins in a way your company can absorb. Dax will take it from here and explain the market environment and dynamics that create the need for new strategies and tools aimed at operational efficiency. Dax?
Thanks, Susan. So why predictive analytics and why now? So we said the market dynamics and the need for profitable underwriting have changed considerably over the last couple of years. A number of trends are conversion in the marketplace that are now causing carriers to focus on underwriting in order to create a more profitable operation. The shift is the decline in investment income, which directly relates to poor ROE. With a multi-forecast of continued low interest rates, insurers into their core underwriting business to turn a profit. With shorter hard market cycles and protracted soft market cycles, insurers not use the hard market to save past poor underwriting results. And time is another factor carriers are grappling with. Underwriters have to process higher policy volumes in shorter amounts of time. Study shows that agent response time matters. Those that are able to respond quickly, usually in a matter of minutes, and yes, I did say minutes, win business. Lastly, industry analysts are saying that carriers can be at a disadvantage if they are not using predictive analytics. And Partners released an in-depth study last month where they concluded that carriers not using predictive analytics are more susceptible to adverse selection. Adverse selection happens when a carrier with better information and pricing tools will select and win the best business and leave business to the carriers without the information and pricing tools. So I'm going to share a case study to illustrate adverse selection a little later. So this is predictive analytics. It uses statistical and analytical techniques to develop multivariate models that enable accurate predictions about future outcomes. Predictive models enable powerful and sometimes counterintuitive relationships among data variables that emerge and other ways may not be readily apparent. These multivariate models improve a carrier's ability to predict the future outcome of a policy with great accuracy. For instance, trying to predict loss ratio in the future term. Now, that being said, predictive models are a tool. They are not reality, and it's important that models are intended to be a representation of what might happen and not a proxy for what will happen. So let's turn our attention now to what it is to prepare your organization to implement predictive models successfully. Also look at the questions you'll want to answer for your organization when considering advanced data and predictive analytics. So it's interesting, what we found most important in this whole process is full commitment, and usually from the CEO directly. If not the CEO, at least the P&L owner of a line of business. And these people usually want to know three things. Number, they want to know that the model works, and they also want to know that predictive analytics will drive meaningful and demonstrable benefits. For example, drive profits, loss ratio improvement, pricing accuracy. The value they provide is on the cost. Now, to understand the implications of the organization, they also want to know things like IT impact, change to underwriting workflow. How writers receive the models, how will they be trained, and the implications to our agency relationships. So we want to address these questions in a couple of different ways. You have to prove it works. You know, we created pilot projects with just about our customers, just how predictive models will impact their book of business. What you do is run a historical set of unseen data through and then show the before and after effect of using the model. Basically, we're trying to prove, can the model improve underwriting decisions? To ask, how do you measure success? It's to identify concrete goals for what will determine success within your organization. For instance, do you have a target loss ratio improvement? The most important result from the use of advanced analytics to more competitively, or is it to grow premium? What are success metrics for your organization? They should be upon with the executive management team prior to embarking on any predictive analytics project. So Tad Frost, Chairman and CEO of GenRe, has that predictive modeling is changing the game and it really requires execution excellence for success. Now, he suggested answering questions like, what is the appropriate risk appetite for models? And do we understand the sensitivity to the assumptions being made in the models? These are have to know and have to understand as you embark on these projects. And in light of the model's limitations, how do limitations impact our projected results? These are all fantastic questions that will help build confidence in your organization that you can monitor and validate the model's results. And finally, the CEO, we think, will want to know how to be implemented successfully. We've used several effective strategies to get the organization on board and facilitate the change management process. It is a change management process, and you have to recognize that this is part of the entire predictive analytics implementation. There are top-down and bottom-up strategies and communication plans for each. Your job is to figure out whether a top-down or a bottom-up strategy is right for your organization. So one of our customers made a declaration to implement a predictive model in a top-down approach. And it was prescribed and followed at every level of the organization. Quite successfully, I might add. And they've also been in production for 4 years and have produced tremendous benefits. Another customers took a bottom-up approach and did underwriters during every step of the way from pilot to implementation with a deal of transparency and gave the underwriters and all stakeholders an opportunity to ask almost unlimited questions. We did several workshop sessions to talk through counterintuitive examples so that we had time to understand the value of the counterintuitive scores, well of implementation, and Carrier 2 is having tremendous success. One of the successful implementations we've seen comes from Carrier that developed a comprehensive marketing and education program for their independent agents. Designed specifically for agents to explain what the predictive model included, and what the impact might be to their insureds. These are all things that we want you to consider as you embark on a predictive analytics project. So, still you at this point may be thinking, this all sounds great, but my resources are so backlogged that building and implementing a predictive model just isn't feasible. You're competing priorities like a new core system or other IT projects. Tie up IT resources for the next 12 months or even longer. We see carriers frequently, and it is my opinion that it is a misconception that predictive analytics requires or has to require large internal IT resources. Now, it is common to see internal or consultative-driven predictive analytics projects take 12 to 18 months or more. But alternatives and external solutions that have reached a level of maturity in quality, robustness, and speed to market. Now, in that case, because we build models built on industry-wide data, that are calibrated to each carrier's book of business, our customers average 40 to 80 hours of total IT time for implementation. I said 40 to 80 hours, not days. Now, the caveat to remember is that no matter how much you can keep the burden off of your IT department, you still need strong commitment from IT in order to move a predictive model project forward and for its ultimate success. You may be thinking, do I have enough data? It's a good question, especially if you have a small to medium-sized book of business. You have an important decision to make. You have whether to build a predictive model on your own data within resources for external consultants, or to use an industry-wide model. And there are, of course, pluses and minuses to both. Use your own data. The biggest benefit is having a custom solution that is built for your business. The downside is that it takes time to get to the market with that solution, as we said, 12 to 18 months. And there's an inherent selection bias building a model on your own data alone. And I want to talk about this just a little bit more. So selection bias can occur when predictive models are built on a carrier's own data solely. For instance, it has a risk appetite, risk selection guidelines, and underwriting guidelines that help you define your profile of business. For a reason, your data only contains those policies that you choose to write, and those policies you didn't write, or policies that you didn't even see. Therefore, if you build a model on your data alone, the data set will only include those policies that your writing practices selected. In addition, they do not represent the entire market. If you write free dynamite haulers, your data would include only loss-free dynamite haulers. Now, it's ridiculous to assume that all dynamite haulers are loss-free. But a model built on your loss-free dynamite hauler data could have suggested that. Now, while it's a farcical example, it illustrates the selection bias inherent in building models with limited data. Now, it's important to note that carriers can leverage third-party data, such as from D&B, Experian, and others, to their own data. Now, typically, this type of data can help inform which variables to use in their predictive model, and it can expand variable selection. But I want to emphasize that this external data will not solve for the selection bias issue we just discussed. So what if you use a model built on industry-wide data? It also has its own pros and cons. On the best side, industry-wide models remove the selection bias concern because they are built with a large consortium database that includes data from multiple carriers. The model is then calibrated to a carrier's book of business to customize the implementation. And it's a quick-to-market solution requiring 2 to 4 months from beginning to end. Now, the potential drawback is that your organization has to believe in the benefit of a consortium database and contribute data to that consortium database. Ultimately, the path you take, internal data only or consortium data, is a core decision that you have to make as you embark on a predictive analytics project. But one of the final and most important considerations is how the organization will consume information produced by a predictive model. Will it be prescriptive instruction based on a predictive score? For example, if the score equals X, then the price equals Y, period. We'll use underwriting guardrails for underwriters to make price decisions within a certain defined range. Will it be used as one information-based tool among many underwriter uses to make risk selection and pricing decisions? Reporting will be in place to monitor both performance and actual results. What is the level of transparency you want to provide to underwriters, agents, and management? This is a critical question to ask yourself and think about a top-down or bottoms-up approach. Importantly, you have to answer the question, what happens organizationally when an underwriter disagrees with the model? Question you have to ask yourself, what do you do in that case? Because it will happen. With practices in mind, Matt Fisher, who heads up product strategy and development for our workers' compensation division, will give an example of how a customer of ours began with one project in Predictive Analytics and incorporate this in manageable pieces. Matt?
Next. Okay, let's just take a look at a regional workers' compensation carrier who came to us and wanted to see if predictive analytics would create a competitive advantage in the marketplace, and they chose new markets for growth. This carrier, using more traditional methods of underwriting, was doing pretty well, writing about 9,500 policies, which we reviewed, over a historical 3-year period, representing $180 million in with an overall pure premium loss ratio of 87%. What we did was create a competitive scenario using the same 9,500 policies they previously wrote in that 3-year period. We split the underwriters into 2 groups. The first group using only traditional underwriting, or how the carrier priced those policies historically. And the second group we armed with predictive analytics. Our predictive model in workers' compensation provides predictive scores. The first is the risk score, which predicts a new policy or renewal policy's prospective term loss ratio and provides to the underwriter a price indication that they can then use to more accurately select and price policies. The score is a misclassification score, which predicts the percentage of exposure that is misclassified on a policy so that the underwriters can proactively ensure accurate and adequate pricing to exposure. And the third is a premium impact score, which identifies the additional or return premium impact of any misclassified exposure that occurs on policy at the time that it's being underwritten. Then allow the 2 groups to compete against one another to win the business. The first group pricing the way they always had, and the second group pricing in accordance with the predictive scores. The first group, as we see here, wrote about 5,600 policies for a total of $110 million in premium or so, and they wrote that at a 99% loss ratio. The group wrote fewer policies, 3,900 in fact, for a total of about $69 million in premium, or less than half of the total policies in premium available in the market of 9,500. But both those policies at a pure premium loss ratio at just about 79%, creating a 20 loss ratio point gulf between them and their competitor. Now, what does this case study tell us? A couple of things. Being able to utilize a predictive model to make decisions allows underwriters to write more profitable business and to avoid writing bad risks. Second tells us is that traditional underwriting, or the control group here, suffered from adverse selection. Sure, they have policies, but both of them at a significantly higher loss ratio. In fact, in today's low interest rate and price competitive environment, I would dare say that 99% loss ratio is unsustainable over time. Lastly, having greater confidence in their ability to select the right risks and price those risks accurately, where the market would allow them to, the second group of underwriters were able to more aggressively target the best policies, which ultimately gave that company the confidence to target new markets. On an early win like this, focus on one area of their operation, in this case underwriting, allow carriers to broaden their implementation across their organization over time. It's easy to grow your organization's use of analytics more thoroughly and more broadly once you have experience and success with a particular area of your organization first. This organization learned 2 important things by using analytics in their underwriting department. And very important, Dax touched on this earlier, is to navigate counterintuitive examples presented by the predictive analytics solution that an organization chooses, and to wrestle with cognitive bias that is inherent in the traditional way of underwriting. Predictive models help carriers make data-driven decisions, and consistently across their entire underwriting staff. But it's important to remember that predictive models uncover relationships that can be very counterintuitive to underwriters, and they otherwise are not very apparent or intuitive. And a certain percentage of these predictions are going to be incorrect in particular. But at the day, those predictive scores are going to be more correct in the aggregate than human judgment alone. It is critically important for an organization to understand what they will do with counterintuitive examples and to build in the flexibility for underwriters to work in concert with the predictive analytics solution. The thing this carrier learned through this exercise was how important predictive analytics is in protecting an organization against adverse selection in a marketplace that is quickly introducing predictive analytics as a table stakes solution. Adverse selection, as Dax explained earlier, occurs when insurers compete for business, but one carrier takes advantage of additional information available to assess the true risk of the insured. An insurer who possesses the risk information advantage is going to be pricing risks more accurately. Consequently, insurers not using similar information are more likely to bind the high-risk policies and to price those policies more accurately. The just provided is an example of adverse selection for the underwriting group not using predictive analytics. Lastly, just quick, it's important to note that if you just look at the difference here between premium and the loss for each of these carriers under this scenario, you loosely call that profit. Group 1 made $1 million. Group 2 made $15 million. And they did on less than half of the total available market premium in this scenario.
Thank you, Matt and Dax. We're going to get to your questions here in just a moment. Just review what we covered today. We talked about market dynamics that are putting increasing pressure on organizations to drive profits for marketing. We talked through a series of questions that need to be answered within your organization. Things like, do you have C-level commitment? How to incorporate analytics with underwriters and agents, and the kind of key resources that are required. We discussed the importance of data and modeling concepts like selection bias and adverse selection. Finally, we showed a case study that demonstrates you can take these important steps in bite-sized pieces in order to move forward and get your whole organization learning. So now we will take your questions. You can submit them on your participant panel in the Q&A text box, and we have one question to get started with, and this is for Dax. Dax mentioned limitations in models and things to watch out for. Are there specific examples that you have in mind?
Well, I think direct to me, but I would punt that over to Matt.
Limitations in models and what to look out for? I think there is a limited amount of information in any given data set, including consortium data sets, that a model is going to be predicated on. A lot of them have to do with the historical loss profile, all of the different rating variables that you can get your hands on, like the hazard group, the industry group, the governing class, exposure allocations across class codes. But, underwriters always need to remember, and underwriting organizations need to remember, that the number of things that do not exist in the data that predictive analytic models are predicated on. They include things like loss narratives, loss engineering reports, whether or not a safety program has been implemented or not, how old or how young the management is at a given business or insured that's out there in the marketplace, and also where a lot of the claims that are being used in a predictive analytic model deriving from. Are they derived from a discontinued business operation? Were they proximately caused by some kind of machinery that now has some sort of a lockout tagout program or has a guard on it? So as underwriting organizations begin to use a predictive analytics solution, it's very important for them to deeply understand the variables that went into that solution that they're going to be using, so that underwriting can create a synergistic advantage over and above what they're looking at, to be able to, quote unquote, underwrite between the lines and to understand where they can ask questions to help improve the overall lift that the predictive analytic model is going to give their organization at the end of the day.
Great, thank you, Matt.
Yep.
So we have another question And, you know, it's aimed around how do you really forecast what you expect the bottom line results to be, and what is a realistic loss ratio improvement goal when forecasting, and what should I keep in mind when forecasting bottom line results from predictive models.
So we, across carriers, an average of a 5.5 loss ratio reduction or loss ratio improvement. That's across carriers, dozens of carriers that we've worked with. It's reasonable to expect that kind of lift. We think it is. But you're doing your cost-benefit analysis, we think that you ought to be conservative and point to, you know, a 2 to 2.5 point reduction or improvement. Some things to watch out for, we've already talked about. Selection bias can really reduce results. You know, I think you've got to be careful in your algorithm selection you use to build the models. We've straightforward GLM type algorithms are best. You can do machine learning and get some really wacky results. You know, one thing we've seen, and we do use machine learning, but not often. You know, you'll get things like drivers that 31 are good risk, drivers that are 33 are good risk, and drivers that are 32 are bad risk. What do you do with information? So you just got to be careful about how you use algorithms to build your models. Matt, do you have anything else to add?
No. Excellent answer.
Okay, well, we have another question. Are there any types of policies for which predictive modeling should not be used? How do you determine those types of policies?
That's a great question, and there are certain types of policies that, unless you are particularly focused on the type of policy, you end up with sample bias. For instance, if you write 10,000 guaranteed cost policies, you only have 3 retros in your book of business, the last thing you want to do is build a model on that sample specifically to predict the retros. When we build models, typically we have pretty robust conversations about the following types of policies. Retros, loss deductibles, policies that are part of a construction wrap-up, master policy PEOs that are not capable of being discretely out within a data set that you would build a predictive analytic model on, and other policies like temp agency policies where you've got lots of different legal entities with completely different characteristics and management regimes under the same policy, so that it's very difficult to separate the signal from noise. Typically, most of what we see are guaranteed cost policies. I will say that if you do have large loss deductible or middle deductible policies, if you can recast those on a ground-up guaranteed cost basis, you can still get a very good read at the outset on those types of policies. And there's a little bit of additional predictive analytic work that is necessary in order to identify the appropriate deductible level, but that can absolutely be done. As an adjoinder to my answer, I also just want to point out that in terms of premium size, what we have seen with history models is that you can go all the way down to sub $1,000 premium sizes and all the way up over $250,000 per policy in terms of premium size. As long as you've got a fairly robust sample in those premium sizes, you can build a predictive analytic model that will work very well regardless of the premium size that you're going after.
Thank you, Matt. Anything, Dak?
No.
We are at time, so I want to thank everyone again for attending today's web seminar. It will be available for download, and we will send you the link here shortly. Thank you so much.